The big driver of markets obviously at the moment is the outlook for inflation, and the market's trying to goad the Federal Reserve to do more. What we've seen from the Federal Reserve is they will do what they think's right, and they've got no qualms about turning on a sixpence in this stuff. And if they start to see the inflation drivers fall, I think they'll cut rates quite aggressively. And obviously that's going to be a big boon for tech stocks and for long duration assets like bonds.
We've seen some data that suggests that there is still some resilience in the consumer, that actually the Fed hasn't killed off the US economy. The labour market remains strong here. Why believe that inflation will come down so quickly when the fear is that we have sort of second round effects now running through the labour market, and we've seen some evidence of wage growth pickup?
Yeah, I think that's right, but I think a lot of the analogies that people are drawing, they're going back to the 70s and these periods where you've had wage-led inflation. This time round, it's completely the opposite way around. So it's obviously it's cost push inflation, and companies are being forced to respond to that because people's living costs have gone up through food costs, mainly in the US and obviously in the UK and Europe, with energy costs increasing as well. So they've been pushed into that. But remember also that wage inflation has lagged headline inflation rates. So people keep going back to this, and I think if we see the tightness in the labour market start to ease off, which we could start to see, in the coming months, that'll give the Federal Reserve and particularly the European central banks, they'll feel much more confident about not tightening rates so much.
I want to pick up on your tech comments there, because many in the markets now believe that we're still missing this headline picture, that the Fed is going to stay higher for longer, which doesn't really give tech stocks much encouragement. And if you think about what we've seen already, it feels as though you've had more trading, dynamic trading around areas of the tech market than investing, and that is very beaten up areas of the tech sector have been rallying hard, even meme stocks. Yeah. That's a dangerous environment. That's not investing.
Yeah, that's right. And of course this is the part of the market where the short sellers are very heavily involved. So if you get it wrong, you get cleaned out very, very quickly. But it does boil down to interest rates. And also I think with tech companies, their growth trajectory is kind of exponential. They don't grow like a sort of tobacco company where it's sort of single-digit growth. If you invest in the right tech company, it goes exponential. And of course, some of these tech companies have sold off very, very materially. You've got Meta and companies like Tesla who have sold off 70+%. And the last time I can remember seeing a sell-off to that extent was back in the original tech bubble sell-off in 2000, 2001.
But if you think about how some investors do trade that type of stock trade, it's worst case trade. It's had been an absolute bloodbath. So you get back in and you recapture some of that. But typically there can be nothing left after you've picked up the worst trade.
Yeah, I think that's right. I think things like meme stocks, that's more attuned to speculation. So not all tech, but I think real companies like Tesla, Meta, these companies now do look quite cheap. And of course, we're starting to see more buyback activity in some of these large cap tech stocks as well, which again will provide some support to the share price.